Federal Reserve 101, an introduction to the history, purpose, and function of the Federal Reserve Bank of the United States. I'm Dr. Jeanette Landon. So, everything you should know about the U.S. Federal Reserve Bank system. We will discuss the function of the Fed, monetary regulation, what paper money truly is, structure of the Fed, interest rates, the Fed and economic stability, and how the Fed affects employment. The function of the Fed. It is to foster a flow of credit and money that will facilitate orderly economic growth and a stable dollar. The Fed was instituted in 1913 with the Federal Reserve Act. This act ensured the elasticity of currency, the discounting of commercial paper, and an improved flow of banking. It also stabilized credit and lending among different states within this country. This act also stabilized monetary value in terms of its use for purchasing goods and services. The Fed's policies influence the credit available for banks to lend to consumers and the interest rates they charge. So, monetary regulation. First question, what's money? Money is a means of payment, a standard of value, and a store of purchasing power. Banks must keep a reserve of cash equal to a percentage of consumer deposits based on what's called net transactions. Net transactions means money taken in minus the money given out. The reserve requirement was originally 15%. It is currently 10% with a minimum of 3%, but it fluctuates based on Fed policy under Regulation D and is kept for demand withdrawals. Demand withdrawals are customer requests for currency, such as going into a bank and withdrawing money or simply going to an ATM. The rest of the currency available is used for other lending. The regulation of the Fed allows each district to be responsive to regional economic conditions. So, what money truly is. I've placed some circles and arrows, and I'm going to go clockwise to explain this to you. So, starting up at the top, a Federal Reserve note, that's the first thing that's on the top of a dollar bill, means that your currency is a liability of the Federal Reserve Bank to exchange for goods or services of a comparable value. If you notice, in small print, it says this note is legal tender for all debts, public and private. The next piece here is you'll see the serial number, and this is on every bill. This is a unique serial number identifier. This is per UCC code that identifies this as a transferable note. It is signed by the Secretary of the Treasury. And one other thing on this is where this note was issued. This particular dollar bill in the image was issued in District 12. You see the number 12 and the letter L, and that tells you where this bill was minted and distributed. So the Fed is organized into 12 districts. Each district has directors selected by member banks in the district. The district directors work with the Fed's Board of Governors to establish federal policies, interest rates, and many other matters. This map here shows you where each district is, and also the cities where the federal bank is actually located. Interest rate. Interest is the price paid for borrowed money, and they fluctuate based on three factors: savings and investment in the country, market expectations, and the flow of bank credit and money. Interest rates follow the rules of demand and supply in that the bank's supply of lendable money depends on the consumer demand for withdrawals. Fed and economic stability. Flow of available money influences banks' ability to lend and consumers' ability to spend money. The raising of interest rates can decrease the rate of lending, while the decrease in interest rates can stimulate the economy. In other words, if the interest rates go up, it will deter people from wanting to take a loan at a higher interest rate. While the converse is also true. When you decrease the interest rates, then customers are more likely to go seek credit to finance different pieces that they would like to do. The changes in interest rates are used to keep the economy on a stable course. However, rising interest rates inhibit new construction of buildings, which decreases jobs in the construction sector and affects the availability of new homes for buyers. The Fed adjusts interest rates every 14 days. And member banks have a discount rate, which is the price they pay for obtaining cash. What this means is member banks buy money from the Federal Reserve in their district. They pay an interest rate, which in this case, the current discount rate is 1% as of October 19, 2016. And they will pay 1% to get that money, and then they will lend it out at a higher rate. For instance, mortgage rates are sitting between 3 and 4%. Auto rates can be as low as 0, but that's generally not from a member bank. That's from a finance company. From a member bank, you will probably see an interest rate probably a little bit more than 1% for exceptional credit. And credit in this case is a rating of a borrower's ability to pay that loan back. Remember with all of this that the whole purpose of member banks is profit. These are for-profit organizations that make money. They obtain the currency from the Fed at a very low rate. They turn around, lend it out at a higher rate, and they also keep a certain amount of money on hand for demand withdrawals. So keep that all in mind. How this affects employment. Member banks' abilities to lend money to businesses depends on the availability of funds. Higher interest rates inhibit businesses' ability to obtain money, which could delay hiring and business expansion. In other words, let's say you're an entrepreneur and you go to the Small Business Administration to see if you can get a loan to start your company. If the interest rate is too high, then the chance of you getting the money you need decreases, or your ability to repay that money also decreases. So when interest rates are low, the economy can grow. However, the Fed keeps an eye on economic growth so that we don't grow too fast and run into problems that direction. The Fed also acts as a clearinghouse for checks issued by companies to their employees. So the demand for currency is regulated by the Fed so that just the right amount of currency remains in circulation. Too much currency in circulation dilutes the value of the money, which leads to economic instability. So to conclude, by the way, that is the current Secretary of the Treasury, Janet Yellen, looking at you in the top corner. The Fed's purpose is to make sure that the economy stays in what I call the Goldilocks zone. Not too much growth, not too little growth, just right. Fed policies affect everyone in the economy, from the big banks to the average consumer, because of our dependence on currency as a means of obtaining goods and services. The Fed's policies and the Board of Governors facilitate the ability to have a single currency that is traded at the same rate and has the same value in every state. And so, therefore, the Fed is an integral part of all economic activity in the United States. For more information, please feel free to check out sources, and I appreciate you listening to my video.